When a company decides to be listed on the stock exchange, they need to divide the company up into different parts, and these parts are called shares. When a company is first listed on the stock exchange through its initial public offering, they only release a fixed number of shares out into the open market. It's the company that decides how many shares they want to release. And in this example, company ABC decides to release 7 shares. Now, in the real world, this amount can range from 100,000 shares to 10 billion shares. But for the sake of the example, we're going to stick with 7. So, company ABC has its 7 shares that they would like to sell to the public in order for this company to raise money for future projects that may help them grow. They do this at their IPO, or the initial public offering, which is the very first day they are listed on the stock exchange. So what they're going to do is release the shares out into the public, and the public ends up buying the shares. So people like you and me are able to buy these shares. And these shares are the only amount of shares that can be traded. There's only 7 of them. So this is the supply of company ABC. But it's going to be up to the public to determine the demand for the shares of company ABC. So let's say John, who owns a share, decides that he doesn't like company ABC anymore. He doesn't think it's a good investment, so he's going to sell his share. But then you have Lisa, who might say, I like company ABC. I think it's a great company. I want to buy more. So John sells his share to Lisa. Same thing with Susan. Let's say that she says, I like ABC. I want to buy more. And Maria says, I want to sell my share of ABC because I don't want to tie my money up into this company. I want to invest in some other company that I think is better. So what Susan does is buy Maria's share. And then we could have Bill. Bill says, I really like ABC. I really believe in the company. I like what they're doing. I think they're the next big thing. So he wants to buy more. Susan says, well, I did like ABC, but I'm going to change my mind. I want to sell both of my shares to Bill. So Susan sells her shares to Bill. So as you can see, we're all just exchanging shares with each other from the same initial pool of 7 shares that company ABC released when it was first listed on the stock exchange. Now let's take this a step further and add prices to each of these shares. And this is going to be how the stock price moves. Let's say everyone's shares are worth $10 a piece. But then Tim comes along and he says, hey, I like company ABC. I believe in them. I think they're going to do well. I want to buy some shares. But in order for Tim to buy shares, he has to buy them from someone who is selling shares. So let's say Maria wants to sell her shares, but she only wants to sell them for $10.05. Maybe she bought it for $10 and she says, I bought my share for 10. I don't think ABC is going to go up any higher. I just want to make a quick 5 cents and get out. So I am perfectly happy to sell my shares for $10.05. And then Tim says, hey, that's totally cool. I'm glad to buy that share for $10.05 because I believe company ABC will be worth much more in the future where I can sell and make a bigger profit. Now, since the last transaction was $10.05, theoretically, everyone's share is now worth $10.05 because that is the price someone was willing to pay, and therefore, that's what the share is worth. Now let's go the other direction. Let's say Zachary comes along and he says, I think ABC is priced a little too high. I'm not going to pay $10.05, but I will be a buyer if someone sells me shares at $9.90. And let's say Lisa was watching TV on a particular day and she saw on the news that company ABC is getting sued. Lisa says, hey, that's bad news. This company is going to drop in value. I want to sell my share before that happens. I want to get out immediately. So she sells her share to Zachary for $9.90. And because of that one transaction, everyone else's shares are all worth $9.90. Now, in a real world scenario, these transactions are happening at the speed of light with hundreds or thousands of shares exchanging hands every second. So the price is always changing. But it's all based on what the people think the future worth of that company will be. And just like from our example, everyone has different opinions. So, in order for the stock price to go up, there has to be a reason for the majority of people to believe the price will be higher in the future. And in order for the price to go down, there has to be a reason for the majority of people to believe the price will be lower in the future. It's all supply versus demand. The initial number of shares that were released by the company, which is in this example 7, is the supply. And if the demand is high, meaning lots of people want to buy shares of that stock, then the price will rise. But if the demand is low, meaning no one wants to buy shares and instead they want to sell them, then the price is going to fall. So that's the very basics of how stock prices go up and down. I hope you learned something. Thank you so much for watching.